Today is the calm before the storm. We have a tremendously busy week coming up this week with economic indicators, the FOMC, the Chicago National Activity Index came out today and turned negative. The Fusion Index turned negative for the first time in a long time. The economic indicators are really important right now. Everybody's paying really close attention, especially these leading indicators that are also a lot more negative, or at least not nearly as positive as they've been. We also have a big basket of earnings this week, starting tomorrow morning, across all pretty much a third of the S&P, but almost all of the big mega cap names. So big week, and so not surprising this week was very light, very small range, very light volume, very inside day. I mean, it was like a calm before the storm. So I'm going to break down kind of what it might look like coming out of the storm, what some of these indicators are showing us, what the trends are seeing, and where the resistance levels and support levels are. And then we'll take a look at our trade idea of the day and the kind of the really important semiconductor industry, and see what it's looking like and how we can trade one of its big bellwethers. So let's go ahead and get started. Today is Monday, July the 25th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel, click that thumbs up icon to like our video, comment down there on the video, join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Join our site for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these things over here on the right. Come down here, click on this heart, opens up this tab. Hit this like button that pops up. Also, same thing, click on this thumbs up icon. Opens up another new tab, hit that like button. Again, the more you do that, it helps get our content out to more of our followers. All right, well, let's start off taking a look at the S&P 500 here with the market forecast indicator. You can see we're still kind of holding up here, well above the 30-day moving average, easily in bullish territory, 3 1/3%. Above the intermediate line actually has now also entered bullish territory. So not only is it above 50, which is what gives you the dark green shading, but it is now in the green, above 60. So that's bullish territory. Again, we didn't get into bullish territory there, and we did briefly. We had an intermediate run there. We still don't have the green line, which is the 30-day moving average turning higher. It still hasn't turned higher yet, so keep that in mind. The near-term line is down, so we are at we're coming off of a near-term peak. It didn't last very long. A typical near-term rally lasts 7 days. Well, you had 1, 2, 3, 4, 5, 6, 7. Or 7 to 12 days, excuse me. This is on the kind of the low end of that range. Of course, it's not over yet either. It's got to get below 40 for it to end. So let's keep our eyes on that. We are above all these lines, these Fibonacci retracement lines. Here's the kind of the big one here at 4,200, because getting back above that gets you above this high, and also gets you above that 23% retracement line of this market sentiment, of the prior market sentiment rally, which would suggest that we're starting a new market sentiment rally. If this is the low point, it's obviously well above the last market sentiment low, which was the COVID low. So you would expect that we would now start new highs. So 4,200 really in that area up to 4,250, it looks like. Really important resistance if we end up getting through this line, this 4,000 area. That's acting as a little bit of a resistance right now. If you look at the NASDAQ 100, not only is this intermediate line in bullish territory, but it's actually almost in the upper reversal zone. So, and we do have a green line, at least we will tomorrow, on the moving average. It is turning higher. You can see it also failed to get up above that 30-day moving average. There's that same 23% line that we talked about in the S&P. So we'd have a long ways to go on the NASDAQ. It's actually still below the 38% line, which we have not gotten below significantly on the S&P 500, and the same holds true for the Russell. See, we're also below the 38% line on the Russell, so we have some more resistance there. Even again, it's also in bullish territory. It also got in bullish territory over here, and its near-term line actually did drop into bearish territory. So this is a near-term peak, and now the question is, where's the next near-term low going to be? Is it is it going to be higher or lower, compared to this one right here? So that's the market forecast. Going back to the S&P 500, or excuse me, the NASDAQ really quick. You can see its near-term lines easily. So it's been the most bearish in the last couple of days. Its near-term line has easily dropped down. Its momentum line also got a little bit more oversold. Its market sentiment line is rising. However, it's above the 20th percentile. So we do have all market sentiment lines rising above 20 here. In bearish territory, rising nonetheless. So a good sign that we actually have, at least we have that going. It'd be a really, really good sign if we can get a near-term low point here, in this area, 1783, in that area for the Russell, the S&P, essentially just if we can just kind of pull back to these old highs, 3,900 maybe at the worst, and then bounce off of what would be an easily higher near-term high point, then we have a good chance of getting a run up to 4,200. That's what kind of people are expecting here, especially considering some of these indicators that we have working in its favor. Let's take a look at the weekly candle, and you can see we did close above the last prior. We got a bullish candle, we got a little bit of a lower shadow, but we did get a green line, and we did close above last week's high point. Even if we did, we were flirting with a red arrow again on the S&P here today. The PPO is rising. The differential, at least it's not a closing above last week's high, but at least it's a higher close, and there's no lower shadow yet. So it's one day, but so far we're okay on that bearish on this candle, on it being a bullish candle. Same thing on the Russell. Got the green line last week, green arrow, last week. That means we closed above the 10-week exponential moving average. But again, we're not anywhere near closing above that high point. And when you're starting bullish moves, for an example over here, you like to really get going, at least get moves up above these highs. This first couple of weeks really establish the bullishness, and then we just don't get lower. We get higher closes, we don't get lower shadows. So we're getting higher close, we're not getting a lower shadow, but apparently we've only had 1 week of closing, not really following through with more significant buying there. Let's look at the 3 green arrow chart for all 4 indexes. You can see we have green shading across the board, green line, remember, on the Qs, but you can see the histogram is falling. That's probably the closest to getting a red arrow. So we'll keep our eyes on that histogram to see how likely we are. If it does something like this and turns back up, that'd be great, but that's kind of what we actually need to see. You can see the MACD's actually been green for quite a while on the MACD, which means when you look at the 2-line version of this chart, that the MACD itself has been above its moving average for a good chunk of time, and throughout most of this time we've been above the 17-day moving average, right? We were above it for a couple days there, we were above it, and then we were in, we came down, we didn't drop hard because we were in convergence mode. We are above it again for a couple days, dropped back down, but it didn't drop too hard. You got the lots of open bars, even though they're red, because we're in kind of convergence mode. We're rallying again, we're being above the 17-day moving average for longer this time, so a little bit more bullish from that perspective right now on the S&P 500. Let's take a look at the some of these other oscillators. Let's see if we got some breakout patterns here. You can see the S&P, the positive indicator, not quite getting up above 30, which is what you'd like to see to really signify a breakout, right? Get above 30 with the negative getting below 20. That's what gets you the green shading and the eventually the light green and then the dark green shading, right? That's what happens every time you get a good bullish trend. You get the green shading when the ADX rises. Well, to get the ADX to rise, you got to be above 30 and below 20 on these separate oscillators. And we're not above 30 yet, and we're flirting with getting below 20 on the negative. So we're not quite below 20 there yet either. Looking at the Qs, which has been more bearish, previously was more bullish, we did get that, but now, just like that, back down. See, the ADX is way below 20. So it's still got a long ways to go before you get any green shading, right? And the green shadings over here came after some strong bearish runs that initially started that. So we still haven't got, kind of this kind of move where we're starting a good bullish run, and we just keep going, right? Because we've obviously backed down below 30 just like that. And then IWM, you can see very similar type pattern. We did get below 20, we did get above 30, barely, or just about 29.7, so right at 30. But then now you can see not really sustaining the strong momentum. Not getting above 60 yet in the S&P. We did get above 150, but we didn't follow that through with getting above 60. We did on the NASDAQ. We got above 150 easy, got above 60 easy, and now we're just right back down below. So not holding, what would be a good bullish move. Same thing with the Russell. So we'll see. It's only a couple of days, so we might be able to really break out of this and get going to the upside here. Taking a look at the Ichimoku cloud, we are in the cloud, lower end of the cloud, but we don't have a trend going yet. Still very noisy pattern there. The Qs do have a trend going. It's a weak trend, and we're a little bit further in the cloud, but we're still kind of in the lower half of the cloud. And then IWM, you can see same thing, no trend. So I haven't had a trend for most of this, good chunk of time, for most of this year, really. And then you can see the lower end of that Ichimoku cloud. Taking a look at the hull, right, to kind of see how likely we are to kind of roll over here. So, we are still above the 20-day hull. We haven't broken down below, but we're, today was a little bit of a bearish, a transition candle, even more than one what we saw on Friday. You can see the MACD is rolling over in terms of how far we are away from the 200-day hull, and then, it's not turned red yet. We don't have a bearish candle yet. We haven't flipped the parabolic SAR up, but getting a that kind of transition candle like this over here kind of slows down the momentum that you like to see when you're kind of getting going. Looking at the Qs, which remember is a little bit more bearish. It's more of a bearish candle. It's not even really a transition. It's more of a bearish candle there. Like I said, still easily above the 200-day. Actually still above the 20-day. You can't get the 20-day hold to roll over until you're actually below it, so we'll just keep our eyes on that. The other thing too, we kind of been watching to signify that we're getting the breadth to turn over to the upside is this, to at least get above 0, which it did not do there and it did not do here, and barely did over there, but that was when we were just starting. We hadn't started the bearish drop yet. So let's see, if we're going to have enough breadth over the next couple of days to really break through the 0 level and get going significantly back to the upside again. Let's take a look at, so we didn't look at the Bollinger Bands. Let's look at the Bollinger Bands here. You can see again up against that resistance, that Fibonacci resistance, pulling off the band, still in the upper quartile, but pulling off that upper band. And you remember too, we're still red dots, so the bands, they're widening. They might actually break out tomorrow outside the Keltner channel. So let's see, if we're going to have enough of a breakout move. If we can follow through and reverse this bearishness and follow through and break through to the upside, and get a kind of a breakout pattern there. The VIX started off bullish today, gapped up, which normally does on Mondays. You can see every Monday you typically gap up, gap up, gap up, gap up, but then finish down by the end of the day today. You notice we are right back down. We got above 90%. We're still kind of above it at that 23, 36, still above 20, but getting a lower close. So again, a 52-week closing low on the VVIX, and really, really small ranges. The VIX. The range for the VIX continues to be really, really low. When you look at its ATR, dropping down to nearly 2 points on the average range, which is well below what we've seen all year long. And if I were to go out on a weekly basis, you can see it's down below 6, and last week's range was 3.5 points, so well below the average range. So we're really kind of coiling here on the volatility index, kind of setting up for a move with bigger ranges, which unfortunately, since we're not coming down from a big high, the bigger ranges will typically be associated with a move back to the upside in volatility. Let's take a look at today's higher high and higher low. We actually did not get a higher high and a higher low. We did get a higher low, much lower high point though. So an inside day after relatively bullish moves, an inside day. The high and low will still stay in the same and will stay the same, barring a new one for some time if we end up staying in this range here. That's the SPY. The Qs, we did get a lower high and a lower low and barely finished above yesterday's low point, but you can see in the after hours we're already down another dollar. So we're back down below that low point, closing below. So a little bit more bearish pattern on the Qs that we have going on. And again, today's range in volatility, let's see, let's go here. Today's range in volatility, 3.25 points, no gap, like 53 million shares trading hands. I mean, those are really, really low levels, you know, way down here and way down here. Not surprising considering that this is a big week that starts tomorrow with a lot of news, a lot of earnings announcements, a lot of economic announcements. So it's a big, big week. And the market started the week off with a very, very small move, and very small move. And it's kind of pent up for a breakout move coming out of this week, right? Which way are we going to head? Obviously, the market's been relatively bullish going into this week. I mean, it's not like this week kind of snuck up on people. Like we've been watching for this week for the past few weeks because of the FOMC, and we all know that the earnings. This is earnings for all the big mega cap names. So a lot of people have been watching for this week for the last few weeks, and they've been watching it with a little bit of a bullish bias, at least overcoming some oversold levels. So that's my expectation. My expectation is we basically resolve some pretty oversold conditions going into this week. So now we're really not overbought or oversold. We're kind of at a more neutral range where the market can now decide a direction coming out of this week. And if we do go down to the downside, you know, we are in convergence mode when you look at it on the long-term chart, which means that we are above the moving average on the MACD, even if we're not yet below the 17. So any move to the downside will not be the same as what we've seen when the MACD was below its moving average. So keep that in mind. Any downside moves, which I actually expect, I expect that's the direction we're going to come out of it, will be very small, very grinding, and lots of ups and downs as we make potentially a move down to either this low point or slightly lower. That's kind of the direction I feel like it will go out of this week. But you know, keep in mind that it won't be like what we've seen. We've seen some pretty drastic moves, some big momentum, but there was a reason for that because you know, we were below the MACD was below its moving average, which is not the case right now. So what do you think? Do you agree with that? Do you disagree? Let me know in the comments section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Now let's take a look at what's driving this price action. As you can see today, the big move, the big outlier to the upside was commodity prices. They really, really ramped up big time, and so did yields. So again, when commodities and yields are your biggest moves, so yields would be the opposite, of course, of bonds down here. So when commodities and yields are both to the upside, that's inflation, right? That's a big inflationary story, and that put pressure on the Qs. The Qs right now are they have been for the last 6 months. They've been the asset class has been most impacted by inflation. You can see IWM actually rallied today. The Qs rallied off their lows, but you know, at one point in time, when the IWM or Qs were down 1.25%, IWM is still bullish, barely, but still bullish. So, and international stocks really outperforming the U.S. equities with a small little drop in the dollar, and gold also coming down, which is interesting too. Again, considering the inflation story, that you would expect gold to not only necessarily be up on an absolute basis, but also to be higher than equities. And the only equity asset class gold outpaced was the Qs, right? It underperformed all these others. So, but regardless, you can see, like, you know, the yield story and bonds still really dropping down. But you know, keep in mind that they had a really strong day Friday. It filled in some gaps. Friday's gap, it filled that in, and you're still above the 8-day moving average. The 8 and 17 are still above the 30. They're still, you know, above the 50 for that matter too. So I mean, they're still rising. You can see here that, you know, the MACD is still above its moving average. You had a pretty decent volume today. So I don't think necessarily this means that bonds are done rising. And I also think too that commodities, have been relatively bearish for some time, and they're coming off of oversold levels. They're in convergence mode. The MACD is above its moving average, still negative, but above its moving average, while the stock, in this case, the ETF itself is below its 17-day moving average and below some resistance too. Having made its way to the 200-day moving average, and now kind of stalling here at the 200-day moving average and looking like it, trying to bounce back up and get going again. How we do relative to that 17-day will be really important to establish, how bullish commodities will be. Gold, has been really bearish. This is again on a daily chart, way down below its moving averages and well below the 200-day moving average. Again, inflation's been a story for most of this year, and gold's down for the year. Now, it did rally early, but it's really off of its highs. And again, a lot of that having to do with some dollar strength. The dollar, and a lot of the dollar strength actually is having to do with weakness in the euro and weakness in the yen. The euro's been dropping. It's had a nice little rally. It's kind of stalling right now at that 17-day. Again, kind of having a hard time establishing some bullishness. And the yen, same thing. So the dollar's been dropping against the yen down to the 30-day. It's below its 17-day moving average. Now it's a matter of whether it will start to break that 30. And when you see that, like when you see the yen starting to gain some value and the euro starting to gain some value, that will start to put the pressure on the dollar index, which, again, is as high as it's ever been, right? When you go to a maximum chart here and on a weekly basis, as high as this ETF since its existence here in 2007, it's higher than it's ever been. It's higher than it was in 2008, 2009. It was higher during the when we first got coming out of the 2015 when we went in that global slowdown. It's higher than it was in COVID. It's higher than it was at the end of 2016. I mean, it's the highest level it's been, and a lot of that is because the euro is at its lowest levels in 20 years. Right, the euro, if you go on a 20-year chart, the euro is at its lowest levels. But when you look at the dollar against the CAD, the dollar is not at its highest levels in the last 20 years against the CAD. The dollar is not at its highest levels in the last 20 years against the Australian dollar. So it's mainly the tremendous weakness in the euro, and you can see the dollar is at its lowest or highest against the yen in the last 20 years, with a very, very high MACD, which looks, we've seen these high levels of MACD before. We'll see how eventually how it starts to roll back down, and again, we're well above the 17-week moving average. It's a weekly chart, so we'll see if and when this parabolic move, will move. It's been the fourth parabolic move since the credit crisis there in 2011 over here. Since the credit crisis, that's when the dollar hit its low point against the yen of the last 20 years, and since then we've had 3 parabolic moves over there to get us up above parity, above 100, and now we're up 136. So pretty much the opposite side of things. And again, currencies are cyclical, so just like you expected, back down here when you had this big move, and it really wasn't so parabolic to the downside. We've pretty much only had a couple bearish moves. This is a lot more gradual decline. It's been a lot. This has not been gradual. Needless to say, this has not been a gradual decline for the yen. When you look at it on this chart here, and let's look at it on a weekly chart. I mean, the ADX is unbelievably high. It's up, at 6, bigger than any. This is the biggest move according to this indicator that we've seen. The ADX is that high against the euro, against the yen, against the dollar, and you can see the euro's weakness. There's only been that one time right there in 14-15 the euro fell this fast, right? Over here a couple of other times, but each one of those times again was met by QE1 and QE2, and then here at the end of 15 and 16 they had considered raising interest rates, and they held off. They only did it once in the end of 15, and they waited until the end of 16 before they started raising interest rates over here. And of course, the election in 2016 kind of helped things too. We don't have any help coming, fiscal or monetary, from the strength in the dollar that we're seeing right now. So when you look at those two currencies make up 70% of the dollar index. Here's the dollar index, the futures contract, the ETF on that futures contract, and again you can see just how bullish that dollar is, pretty much as bearish as it was over here, and only really more bullish in that 15-16 area. We saw some very strong moves in the dollar. Of course, that's going to have a very negative impact on economic situations when the dollar is this strong. It's okay for the dollar to gradually trend higher. It's not okay for it to move up this far, this fast. It has, obviously, as we've seen, some negative impacts on economics, and as long as it stays in this direction, you would expect it to continue to have some negative impacts on the economy and earnings for that matter. And again, keep in mind, this strong dollar is with very high inflation rates. Imagine what those inflation rates would be if the dollar was down here. They'd be a lot higher. Imagine where commodity prices would be. Again, imagine where commodity prices would be if the dollar were down here, right? The fact that the dollar's way up here has really kind of kept a lid on commodity prices from going up too drastically. I mean, the ETF's gotten up to 30. If you look at crude oil, did not quite get up to 150, but it did get up to 120, 130 even. Imagine where it would have gotten to had the dollar been weak instead of strong, right? At least, let me put it this way, had the euro and yen not been so weak themselves, not just against the dollar, but against everybody, they had been so weak that it propped up the dollar and put a lid on commodity prices, gasoline prices, utility prices, things that are all denominated in dollars. All right, let's take a look at these sector moves here. And just look at today. You can see the big winner, not surprising with commodities doing so bullish, was energy stocks up 3.5%. When you look at the second biggest winner, is not what you would like to see if you're bullish, right? Your three biggest losers are the leadership of the market. So not as bullish of a day as you'd like to see. When you take a look at like energy, for an example, like commodities have pulled down to its 200-day moving average. Remember, a lot of these other ETFs are actually below their 200-day moving average. So energy finally got to its 200-day and now is looking to get back above its 17 and eventually above some of these other lines too. XLK, on the other hand, did get above its 17, got back above its 50-day moving average into this area of very low volume. But now its histogram is rolling over, so we'll see how long it can stay above, in this case, a 38% retracement. See if this ends up being a fake out, a resistance fake out there that could lead to be more bearishness. All right, so our trade idea is coming from that technology sector. So let's take a look at Micron here. Very oversold in the short term, the near term line, momentum line getting down into oversold levels. You can see the price of the stock itself is still more than 2.5% above its moving average, but well off of its peak there at 7.75. So easily pulling back down. The intermediate line not quite getting up above 60. When you look at its 3 green arrow chart here, especially on the 2-line version, you can see we held the 50-day moving average for resistance. We had a gap between the 30 and the 50. It's been widening. We held it. We came down. You can see the histogram. The stochastic is already below its moving average. The MACD looks like it's about to cross below its moving average in another day or two. So you can see how bearish that is for Micron. Still easily below the value area. So very much in bearish territory from that perspective. When you look at it on a weekly chart, the MACD is flirting with getting above the moving average, whereas the price itself is still easily below the 8 week. So, again, don't expect big moves to the downside, but because the MACD is not, it looks like it's already washed out here. But I wouldn't be surprised if we don't fill in some of that range when you look at it kind of like on a monthly basis. We get kind of this piercing line, this big candle here. I expect it will still fill in some of this. As you can see, the MACD is just gone negative. The 8's just barely crossed the 17, and we're just now dropping below the 50-month moving average there. So getting pretty bearish from that perspective. But so I don't think we'll be dropping hard, but I do think There's some weakness here on the daily chart that suggests we might come into this area, especially considering a lot of this up and down was kind of earnings related, big moves to the downside post earnings, and then a very, very quick recovery there, engulfing pattern. It kind of acts like a long lower shadow, which makes it very easy to fill in that range. So what I decided to do was to do a bearish trade, but not a super directional bearish trade, but more of like a bear bear call spread. So we went to August and we looked at selling the 63 and buying the 65. Remember, we're post earnings, so we went for a full position size on this. So let's go down to single symbol, full position size, getting a pretty decent return. That break even is actually above these old high points. So there's the break even right there. So as long as we kind of stay below that old high, then we're fine below the 50-day. If we break above that, then we'll want to be out of it, right? Because we'll know that it actually is rolling over. You can see back below its 17-day there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, like us on Twitter and Facebook as well. Join our website at marketscholars.com for free. Have a great rest of your Monday night, everybody, and we'll see you all next time.